Welcome back, Bulls, Bears and Bowties. This is the third part of the three-part series on corporate credit. Corporate credit was a hot button item for some of our recent news articles that we put out. Paul Tudor Jones, particularly speaking about the problems brewing in the credit market, but certainly in the corporate credit market. The inference being that's fuel for fire for the next deleveraging cycle, drawdown, bear market, whatever you want to call it. So, David, we've addressed the problems in the corporate credit market. What are we telling clients? What should investors do? How do you think about this? Should we just be in cash and hide in the bunker, or what's the solution here?
So, Greg, I'm going to go back a few years, and we had some difficulty. Everybody had difficulty in terms of deriving income for your clients post the 2009-2010 crisis, with interest rates having been driven close to zero. Anyone that was looking for fixed income really couldn't find those income flows from the fixed income markets, from the bond markets. So we at ACG Wealth actually did very little bond business during that long period of time. In the recent past, the Federal Reserve Bank has begun to raise interest rates. They raised rates earlier this week by another 25 basis points. I strongly suspect, by the way, that given the slowdown in economic growth, not negative, but the rate of increase is slowing, that it is unlikely we see more rate increases next year, in the early part of next year. But that being said, what are we doing for our clients was your question.
Yes.
Greg, you and I, as members of the investment committee, you as the chief investment officer, are very cognizant that right now, the last thing we want in our client portfolios, if you own a bond, is a default. So, given we have a yield curve that is very unusual in that it is so flat, 2s, 10s, incredibly, 11 basis points or something, I believe, at the close of business yesterday. We are much more cognizant, we are much more focused on the credits that we are putting in our client portfolios. What are the probabilities of that entity still being in play at maturity date to be able to repay all the debt and service the debt in the interim period? So the focus for us is, clearly you focus on all things. You focus on duration, you focus on the yield curve, you focus on interest rates, obviously. But our focus to date in putting a bond portfolio together is focusing on the credit of individual issuers. And that's the bottom line right now.
Right. Okay. So with interest rates maybe modulating, we're not quite sure, could be flattening, could be rising, so we're staging our duration being less of a concern is what you're saying at
then credit.
Okay. How about private credit? Maybe just a few observations, if you will, on private credit. And maybe explain what private credit is.
So the private credit markets, by the way, were driven by Dodd-Frank, because banks, having been regulated to clean up their balance sheet post 2008, 9 and 10, stopped lending to middle market companies.
Right.
Literally stopped lending to middle market companies. So private markets thought, hang on a moment, if they're not lending, they need, they're looking for debt issuance. We got to, perhaps there's an opportunity for us. And the private market stepped in, very often with in the form of a business development corporation, which has some certain tax benefits, not always. And that enabled the private markets to actually derive debt issuance as well. Greg, they're not quoted on a daily basis, so it's much more difficult to tell what's really going on there. But I'll tell you one thing: if you are allowing a company to issue debt from a private perspective, you're doing a whole lot of balance sheet checking on that before you actually put that deal together.
Certainly,
it becomes a very difficult exercise.
A lot of credit work. I would note that some of the larger alternative investment managers today have really built their business to a large degree on credit issuance. Some of the bigger names come to mind. It is worth saying that the private credit market is illiquid for investors.
Indeed.
So whilst there may be a yield that's paid off to them and maturity dates on the credits, there's not much you can do in between. So you're locked in, but you're achieving a higher return for the locked up capital.
Correct.
Okay, that's fine. Then the last point I'd like to make, and we can discuss this in conclusion then, is it's highly unusual to be sitting in December here and to have the the equity market, let's say the S&P down, let's call it 5% year to date. I'm not exactly sure of the exact number, but at the same time, you've got the Barclays Ag Index, or used to be called the Lehman Ag Index, down on the year as well. Highly unusual situation. I think it's only happened like 3 times in the last century when both, equities and bonds are down. So I'd just love to hear your comments on 2 things really. The one thing is on that issue itself. The second thing is, we deal with a number of different kind of clients, endowments, foundations, clients who've got some kind of spending requirement, and so have got a big fixed income component in their business. We don't really handle too many of them, but the biggest ones that I'm aware of is kind of like a general fund for an insurance company. Typically, that is very, very heavily weighted to fixed income. A lot of those portfolios would be down on the year, more or less in line with the Barclays Ag. So how does that filter? What happens? How does that come through the system?
Greg, insofar as I know, these are not accounted for on a mark-to-market basis. So they don't actually mark those exposures to what the market's doing at any point in time. So you don't see them as recognized losses, is the bottom line. And once again, you go back to that credit story. What they are saying to you, in sense, is these are treasury exposures or some AAA plus exposure that we've got in the portfolio. On day X in the future, they will pay back their loan and we will accrue all our capital back to us.
So it's held to maturity.
Exactly. Not sure it's entirely, certainly honest, but I'm not sure it's entirely, what's the word I'm looking for? It's see-through,
transparent.
Transparent.
Yes.
But it is what it is, and that's the way that people look at that.
Yeah. Okay. Well, I think we've given the credit markets a thorough scrubbing today. The credit markets are by magnitudes larger than the equity market, and so they're generally considered smarter. So what the credit, it is worthwhile for every investor to take note of what interest rates are doing and the credit markets are doing. So,
and do keep that in mind. Fixed income markets, bond markets are way smarter than the equity markets. So.
Very good. Well, at least I'm sure we'll have something else to talk about in a couple of weeks' time, David. Appreciate your comments. Appreciate you being here.
Thank you for your time.
You may just want to leave off telling the folks how to find us if they want to hear more or talk to us directly.
Absolutely. ACG Wealth, best way to get us at ACG Wealth on the Twitter, and we look forward to any feedback whatsoever from you all. Thank you very much, and a happy, healthy, successful new year to everybody out there.
Thank you. Take care.